Here's a number almost nobody shows you. Borrow $300,000 for a home at a normal interest rate, take the full 30 years to pay it back, and you don't repay $300,000. You repay closer to $680,000. Nearly $380,000 of that is pure interest, more than the house itself. So the question is fair. Should you attack that mortgage early and kill the interest, or is racing to pay it off quietly one of the worst money moves you can make? This is Calm Dollar, where we run the real math on the big money decisions, with no hype and no guru nonsense. If that's your thing, consider subscribing, and let's do the part the internet skips. Paying off your mortgage early feels obvious. Debt is stress. A paid-off home is safety. Half the personal finance internet treats it as the ultimate goal. The other half calls it a rookie mistake because that money could be invested instead. Both sides are loud and neither one shows you the actual numbers for your situation. So let's build them from scratch. And by the end, you'll be able to run this for your own mortgage on the back of an envelope. And that gap between the loud opinions and your real situation is exactly where people quietly lose money. Start with the one fact that makes early payments so powerful. A mortgage is front-loaded with interest. In the early years, almost every dollar you send the bank goes to interest, not to shrinking what you owe. On that $300,000 loan at 6.5%, the monthly payment is about $1,900. In the very first month, roughly $1,600 of that is interest. Only about $270 actually pays down the balance. The bank isn't being sneaky, it's just how interest works. You're charged interest on the balance you still owe, and early on that balance is almost the whole loan. So the interest slice is huge, and the principal slice is tiny, and it only flips in your favor near the very end. That's why a mortgage feels like it barely moves for years. Early on, it barely does. Here's the lever that changes everything. Any dollar you pay above your normal payment goes straight to principal. It skips the interest line entirely. And because it shrinks the balance early, it erases all the future interest that dollar would have piled up over the remaining decades. One extra dollar in year 1 is worth far more than one extra dollar in year 25. Early dollars do the heavy lifting. Let's make it real. Same loan. $300,000, 6.5%, 30 years. Pay only the required $1,900 a month, and you'll hand the bank about $383,000 in interest over the life of the loan. Now add just $200 a month, aimed at principal. One dinner out, skipped, every month. Watch what happens. The loan is gone in about 23 years instead of 30. And you save roughly $103,000 in interest. $200 a month buys back 7 years of payments and 6 figures of cash. That is the case for paying early, and it is genuinely strong. To put that in perspective, $100,000 is more than many households have saved for retirement at all, handed back to you just for aiming a small, boring extra payment at the balance. That's the kind of number that changes a decision. And showing you numbers like that is the whole reason this channel exists. If it's landing, subscribe so the next breakdown finds you. Because now, we hit the part that stops it from being a slam dunk. When you throw extra money at a 6.5% mortgage, you're earning a guaranteed 6.5% return. Guaranteed, because every dollar of interest you don't pay is a dollar you keep, with zero risk. That's the honest way to see it. Your mortgage rate is the return on paying it down. Notice what that does. It turns a fuzzy feeling into a hard number you can actually compare. And a truly guaranteed return is rare and valuable. And notice the psychology. A guaranteed return you can't watch go up feels boring next to a market that might soar. But boring and certain is exactly what a lot of plans are missing. It is the return you never have to worry about again. But there's a catch. That same money could go into a long-term investment account instead, where the historical long-run return has been higher, though never guaranteed and never smooth. So the real comparison isn't payoff versus nothing. It's a certain return at your mortgage rate versus a probably higher but bumpy return in the market, which means your interest rate is the whole ballgame. When your rate is high, paying it down is a fantastic, safe return that's hard to beat anywhere. When your rate is low, the kind some people locked in years ago, the math tilts the other way. Because a safe 2 or 3% is easy to beat over a couple of decades. So before you send a single extra dollar, you have to know which world you're living in. There is no one-size answer. There's only your rate and what you would honestly do with the money instead. One quick note people get wrong: the mortgage interest deduction. For most households, it no longer changes this decision because the standard deduction is now high enough that they don't itemize at all. So don't assume a tax break is quietly subsidizing your interest. Treat your rate as your return and check your own taxes rather than a rule of thumb. Then there's the cost, the payoff, cheerleaders skip. Liquidity. A dollar in your investment account you can reach in days. A dollar you've poured into your mortgage is locked in the walls. An emergency fund you can reach is oxygen. Money buried in your walls can't help you breathe when it matters. To get it back, you have to sell the house or borrow against it, often exactly when you're in trouble and least able to. Extra mortgage payments are a one-way door. That doesn't make them wrong. It makes them something to do with money you're sure you won't need. And don't ignore the part that isn't on the spreadsheet: how it feels. For a lot of people, owning their home outright is worth more than a slightly higher return they might earn instead. Peace of mind is a real payoff. It just isn't a financial one, so name it honestly and weigh it on purpose, instead of letting it quietly make the whole decision for you. So here's how to think it through, in 4 steps. First, secure the foundation before a single extra payment. That means a real emergency fund and any high-interest debt cleared first. If you're carrying a credit card at 20+%, paying that off is a guaranteed 20% return. It beats mortgage payoff and investing easily. And grab your full employer retirement match before anything else. That's free money no mortgage can compete with. Second, write down your actual mortgage rate. That single number is your guaranteed return from paying extra. Compare it honestly to what you'd otherwise do with the cash, whether that's invested or just spend it. Third, if you decide to pay extra, make it count. Tell your loan servicer to apply the extra directly to principal, not to prepay next month's bill. And start as early as you can because the front-loaded years are where extra dollars save the most. Fourth, keep some money liquid. Don't empty your safety cushion into the house. Money you can't reach in an emergency isn't really working for you. It's just hiding. Let's bring it home. A mortgage is front-loaded with interest, so extra principal early is powerful. $200 a month saved our example over $100 grand. But paying down is a guaranteed return equal to your rate, and you have to weigh that against investing and against losing access to the cash. High rate, payoff is hard to beat. Low rate, the market probably wins. Foundation first, liquidity always. None of this is about being debt-free the fastest. It's about the choice that leaves you richer and safer, on purpose. If this made the math feel simple instead of scary, that's the entire point of Calm Dollar. So tap subscribe before you go. Next up, we run the same cold-eyed math on investment fees, the quiet 1 or 2% that can silently eat a third of your retirement. It's the most expensive number most people never check. And the reminder, that matters most. This is general education, not financial advice. Your rate, your taxes, and your life are yours. Run your own numbers or talk to a professional you trust. I'm glad you spent this time here. Keep it calm and keep it yours.